Welcome back to Smart Money. Our topic today is early retirement, but more on the lines of is early retirement as glamorous as it sounds? We have Karan Datta who's with us. He used to be the Chief Business Officer of Axis Mutual Fund. He has had a long 2-decadal journey in the financial industry, in the mutual fund industry, and 5 years back at the age of 48, Karan retired. So we are trying to understand from him how retirement, the life after retirement actually is. So Karan, I'll come to that in a bit, right? The softer aspects of it. But before the break, you also told us about how you have a 15 crore corpus,
right,
X of your assets like your house, etc. So now you are sorted with your retirement journey. But tell me, what are the 2 or 3 ways to look at withdrawals post-retirement and determine what a good withdrawal amount should be? Like what would our monthly expenses be and how to structure your investments that way?
Again, I think, Sonia, that's a very important question. And funnily enough, a lot of people don't think about this very hard. They just leave it as if it's something they don't want to speak about or put some thought behind it. And I'm glad you asked this question. There are 3 ways to look at a good amount. The starting point is monthly expenses. And so there are 2 or 3 ways I kind of, whenever I speak to friends, I tell them how to look at the corpus. So the number one thing is 25 to 30 times of your annual expenditure should be the corpus. So if someone's kind of got a monthly expense of, let's say, 1 lakh, then it's 12 lakhs, then 25 times of 12 lakhs roughly is 25 to 30 times is the right corpus to retire at.
Okay.
And if that indicator is done, another way to look at it is whatever is the corpus, whatever, you can kind of withdraw anything between 4 to 5% annually for about a 25-year period. The provision is if invested well.
Okay.
So whatever is the corpus, if it's a 5 crore corpus, you can safely withdraw anything between 4 to 5% annually and meet your expenses.
So this 25 times you said would be your monthly income annually?
No, so that should be the corpus.
That should be the corpus, exactly. So if my monthly income is 1 lakh,
monthly expense.
Monthly expense is 1 lakh.
Right.
And then, so my yearly expense is about 12, 13 lakhs, whatever.
Let's say 10 lakhs, then 10 into 25 or 30 times should be the corpus.
Okay. But are you taking into consideration inflation?
Yes. So this takes into, the 30 times takes into consideration automatically inflation and the way the expenses will go up. That is why it is a multiple of 30 times.
But that corpus is only for monthly expenses. It's not for large expenses like children's education, marriage, etc.
So Sonia, that's where sitting down and putting down goals becomes supremely critical. For example, it could very well be buying a home or, for that matter, children's education, and then finally planning for retirement. And so when I say expenses, the concept of expenses should include all of these that you just mentioned, plus, let's say, education. Okay. So it will inflate. Like 10 may not become 10, it may become 15 because you've actually, said that my child's education could cost 50 lakhs. So you've got to then plan back and see what it means on an annual basis.
Okay. Now, so money is one thing, right? The other thing is time. And I want to know from you, since you've been retired 5 years, what are you doing with your time? And has it been hard for you to make that journey out of the corporate world and into a world where you pretty much have time for everything?
So here's the thing, and someone asked me, very interestingly, someone asked me this question as to what is the most expensive thing I've ever bought. And I suddenly realized, and very intuitively, I just answered the most expensive thing I've ever bought in my life is time. Because I've given up a salary and a bonus and stock options. So with that opportunity loss, I bought time. And so it's very, very important that as an individual, I respect my time and know what to do with it. And remember, Sonia, that this is not a journey which only I'm going to do. All my friends and everyone watching at some stage will hit 60. They need to know what to do with their time because it's still another 25 years journey, 60 to 85, 90, it's still a 25, 30-year journey. So to answer your question, knowing what to do with yourself is very important, and there are no easy answers. It takes a little bit of an effort to figure out what are you truly devoted to, not just passionate about.
So there are a couple of more things here, right? It's not just time, it's also a dip in your social currency, so to speak. When you're working, you are someone.
Right.
Like we were discussing, what are you if you're not your business card, right?
Yes.
So does that switch from having a business card to being nobody but yourself? Is that hard?
You know, I must confess, I thought it may be 50-50 hard, tough, but when I speak to everyone around me and when they ask me what do you do, I just simply say I'm jobless and I'm unemployed. And the response I get is, I wish we could be in your shoes most of the time. Now, they're being very sweet to me, that's a separate matter, but I realize that there is a certain element of curiosity in being financially free. And a lot of people want to attain that status, because finally that's the new way of looking at life. So again, coming back to your question, I think, Sonia, we've gone through that transition of people being very skeptical about leaving early to this generation which wants to be free. And I think financial freedom is the new status symbol.
And what is the best piece of investment advice that you have ever got?
Best piece of... I'm telling you, I'm so fortunate to have been part of the mutual fund industry. That training that I got, my early days were at Templeton, and like they really, you know, teach you managing money, and they ingrain it into you. And the best training I got was that this is about decades. And so every time, whether the markets are up or down, I always take a 10-year view. Just think about this. The average age of an Indian is 26. We are the youngest country on this planet. Then how can long term be 4 years or 3 years? Intuitively, that's incorrect. For a 26-year-old, how can long term be 4 years? Long term should be at least 20 years.
Yeah.
So medium term should be 10 and short term should be 5. When you look at it from that prism, the best advice I ever got was just stay put and ride the journey, because India is a country of wealth creators if we don't make silly mistakes as investors. So just don't misbehave with the money.
Okay, so just stay put, take low risk, stay invested.
And ride the journey.
And ride the journey, got that. So you said that 70% of your money is in equities, 30% in fixed income.
Yes.
Have you, in your 2-decadal journey of investing, ever looked at other things like, say, trading, F&O, cryptocurrencies, short-term, penny stocks? I'm asking because a lot of people get carried away, try to make a quick buck here and there. Your advice?
And I'm being very respectful about all of these instruments, because some of them I don't understand. For example, I've really tried to understand crypto. I could not. So the test that I use for investments is that if I want to invest or suggest an investment, it should pass one test, which is a 16-year-old or an 80-year-old. Both spectrums of the population should be able to understand it at one time. So it should not be so complicated that they don't understand it. And none of these really pass that test. And so I've stayed away from crypto, derivatives, futures and options, penny stocks, because A, I couldn't understand them myself, and B, I think I kind of got married to the 10-year story. Okay. So they do make money. Obviously, they do make money. But for that reason, I'm out.
A bit risk averse. I mean, taking sane decisions, right?
Actually,
taking conservative decisions, so to speak, always works in the longer run, I guess.
No, Sonia, look at it. For a person like me who has no source of income but my investments, I'm 70% invested in equities. That is not technically a conservative investor if you really look at it.
Absolutely.
Because the markets are down 6%, 7% in a week, which obviously means that my portfolio is down. But the point I'm trying to make is that we're not here to maximize the returns. I'm here to ride this out and create wealth. And even at 12% compounding, but over 10, 15, 20 years, is a serious amount of money. Because inflation long-term could be 7%, so that's 5% real return.
Okay, finally, before we let you go, would you have done anything differently? And would you advise the younger generation to take early retirement or not?
So it's a very personal journey, but I'm beginning. I get a lot of calls nowadays from people who are anywhere between 35, I've noticed this, the age at which I'm beginning to get calls on advice is 35 onwards, which basically means that the working population now is beginning to at least think about this. And my advice to everyone is don't let that flame down. Don't kill that flame. Keep that little flame going, because that's the curiosity that you're kind of building for. And at some stage, if not today, if not tomorrow, in 10 years' time, you'll realize what you are truly driven by. And that's when you can kind of say goodbye to the corporate world.
Okay, well, financial freedom is a superpower, as we all know, and I'm so glad that you've achieved it. Thanks a lot, Karan, for taking the time out and speaking to CNBC TV18. With that, it is a wrap on another edition of Smart Money. You folks have a great weekend. We'll see you again on Monday.